All right, today we're cracking open the Consultant's Toolkit. We're going to demystify a concept that's absolutely critical in finance: how to really figure out if an investment is any good. Because let me tell you, it is not just about the final number, it's all about how you got there. So let's dive in.
Okay, let me start by asking you a question. Picture this. You're a client, you've got millions of dollars on the line. Manager A gets you a 15% return. Manager B, 12%. Now, on the surface, this seems like a no-brainer, right? Of course you hire Manager A.
But what if I told you that simple, almost obvious answer could be a disastrous mistake? Yeah, the world of professional finance, it just doesn't work on simple returns. It operates on something much, much smarter.
And that right there brings us to the core idea for today: risk-adjusted return. Now, this isn't just some fancy jargon. This is the fundamental rule that separates the amateurs from the pros. It's really simple. A return number is totally and completely meaningless until you know how much risk, how much of a roller coaster ride the manager had to take to get it. So, how do we measure this? Well, let's start with the first and probably the most famous tool in our kit: the Sharpe ratio. You can think of this as the Swiss Army knife of performance metrics. What the Sharpe ratio does is it boils down all that complexity into a single, easy-to-understand score. Its whole job is to answer one question. For all the stomach-turning ups and downs your money went through, how much extra return did you actually get for all that trouble?
And the logic behind it is actually pretty simple. First, you figure out how much you earned over what you would have gotten from a totally safe investment, like a government bond. That's your reward. Then, you measure the portfolio's total volatility, all the ups and downs. That's your risk. You just divide the reward by the risk. A bigger number is better. Simple as that. But, and this is a huge but, this universal tool has a massive flaw. The Sharpe ratio has a blind spot. See, it treats all volatility as bad. So a massive unexpected jump in your portfolio's value gets punished just as much as a massive crash, because both create turbulence. It's kind of like a teacher penalizing a student for getting a surprisingly high score on a test. That just doesn't feel right, does it?
And that very limitation is exactly why we need more specialized tools. So let's move on to the pro tools and see how they solve this problem. These are the metrics that know how to tell the difference between different kinds of risk.
And this lays out the key difference perfectly. While the Sharpe ratio is looking at total risk, every single bump in the road, our pro tools, the trainer ratio and Jensen's alpha, are way more focused. They only care about what we call systematic risk, which we measure with a score called beta. Just think of it like this. If the whole stock market tanks, even the world's best stock picker is probably going to lose money. That unavoidable market-wide risk, that's systematic risk. It's the tide that lifts or lowers all the boats.
So why would we ever want to just ignore some of the risk? Why does making this distinction matter so much? It matters because of one really important word: diversification. If you've got a really well-diversified portfolio, like a big mutual fund, you've pretty much gotten rid of all the weird random risks tied to single companies. The only risk left that really matters is that overall market risk, that beta. And the trainer ratio is built for exactly this situation. It asks for the market risk you simply couldn't get away from. Were you paid enough? And then we have my favorite, Jensen's alpha. Seriously, think of this as the manager's final report card. There's a model we use that can predict what a portfolio should have returned based on its level of market risk. Jensen's alpha is just the difference. It's the raw percentage that shows whether your manager actually beat expectations. It's the purest measure we have of a manager's actual stock picking skill. But hey, one good grade on a report card isn't enough. As an analyst, you gotta know if that great performance was skill or if it was just dumb luck. And for that, you need a tool designed to measure consistency. And that tool is the information ratio. This one is incredibly powerful, especially for big institutional investors. It doesn't just look at whether you won, it looks at the quality of the win. It asks, how consistently does this manager beat their goal? And it divides that outperformance by something called tracking error, which is just a fancy way of saying how bumpy the ride was. It rewards a smooth, consistent winner over a wild, unpredictable one. So the key here is knowing what you're looking for. For the information ratio, a score somewhere between 0.4 and 0.6 is generally considered pretty good. That's a manager who's adding value consistently. But anything above 1.0, that is truly world-class. That's the kind of performance that builds legendary careers. Now let's grab our final tool. This one is for a very specific kind of client, the one whose primary goal isn't just to make money, but to absolutely positively not lose money. Meet this Sortino ratio. You can basically think of it as a much smarter, more refined Sharpe ratio. It fixes that huge flaw we talked about earlier by completely ignoring the good volatility. You know, those big upward price swings we all love. It only measures and penalizes the bad volatility, the downside risk. And because it's so focused on not losing money, the Sortino ratio is the go-to metric for hedge funds, traders, and really any investor who's more scared of losing money than they are excited about big gains. If your client has a short time horizon or just can't stomach losses, this is the ratio you need to be looking at. Okay, we have covered a lot of ground. We've unpacked the whole toolkit. Now let's put it all together in a simple cheat sheet you can take straight into your next interview. This table right here, this is your diagnostic framework. Each one of these tools asks a different, very specific question. Are you worried about total turbulence? Use Sharpe. Are you worried about the market risk you just can't avoid? Use Trainer. Want to know if your manager is a genuine stock-picking genius? Use Jensen's. Is consistency the most important thing? Information ratio. And if you just absolutely hate losing money, Sortino's your answer. So if you remember nothing else from all this, please remember these 3 things. 1. Return by itself means nothing. 2. You have to pick the right tool for the job. And 3, the real magic, the real insight comes from comparing these metrics. Like if you see a high Sharpe but a low Trainer, that tells you something. It tells you the manager is getting returns from risks other than the broad market, probably by making big, concentrated bets. It gives you a window into their real strategy. And to make this super practical, here are 3 questions you are very, very likely to get in a finance or consulting interview. Think about how you would answer them. The first one is about diagnosing the type of risk. The second tests if you understand consistency versus just raw performance. And the third, it checks if you can match the right tool to a client's actual needs. I'll leave you with this final thought. At the end of the day, anyone can memorize a formula. That's the easy part. The real skill, the skill that gets you hired, the skill that actually creates value, is knowing which question you're trying to answer in the first place. Thanks for tuning in.